The Fed widely expected to see points out to pause again tomorrow, leaving rates unchanged for the second consecutive meeting. Will this be enough, though, to halt the surge in bond yields, especially on the longer end, and spark a year-end rally for the stock market? So here with us to discuss are Tom Lee, co-founder of Fundstrat Global Advisors, also a CNBC contributor, also Michael Schumacher, global head of macro strategy at Wells Fargo Securities. Gentlemen, thank you both for being here so much. Michael, I'll start with you with the bigger picture. We got all ends of the funnel covered at this point here. Big picture-wise, Steve laid out the economic case. Is there a compelling reason why bond yields should stay where they are, the 10-year around 5% or so for longer?
Steve hit the nail on the head. He talked about concerns about the deficit, concerns about Treasury supply. They're very evident. And oh, by the way, tomorrow morning at 8:30, tune in. U.S. Treasury is going to announce supply increases. People are worried about this, Tom. In the last 3 months since the previous announcement, client after client has talked about this. It's not only investors, it's issuers, it's retail investors. Most reviewers, I would guess, are concerned that doesn't go away quickly.
Has it been, Michael, though, absorbed relatively well in this early stage of getting investors on the bond side of things used to this idea that Treasury will be selling more debt?
They get the concept. Big deficit, more issuance, but the speed with which Treasury has ramped up issuance is a bit scary. And I think also when you look at the headline numbers, the deficit's 8% of GDP. That's the sort of number we typically see in a crisis, in a war, in COVID, something like that. We're not in those types of situations now. People are concerned, and it's, I think, weighing in the back of their minds thinking, hey, maybe the deficit goes up even further. There's even more supply than we expect. That's much worse. So that comfort zone is just not there yet.
There is a comfort zone for the stock market, generally speaking, there has been this year, Tom. If you look at your comments in the past, you've been right. Things have been generally more bullish. But what about the last few weeks? Do you think that we're set up for a year-end stock rally if interest rates continue to show at least some signs that they're stabilizing on the long end?
Stabilizing would be very good, I think, Dom, for a year-end rally because we're getting through the tax loss selling. I think the data is going to start to lean soft on the jobs, which I think is good because it takes some of the pressure off the Fed having to do higher for longer. And in fact, it could pressure yields lower. And I think sentiment is so negative now that we are in a situation where bad news probably is good news for equity. So I think the setup is good, but this is a really critical week.
What about this notion that we have interest rates maybe stabilizing, and this overall story in the market's about a certain subsection of stocks, the Magnificent Seven, whatever you want to call them, being the engine behind the market? Is the fall in yields or hypothetical fall in yields that much more of a buoyant part for stories in the stock market because of those Magnificent Seven?
Yes. I mean, for a lot of reasons. I mean, the Magnificent Seven, as you're pointing out, really powered the equity returns this year. They kind of took it on the gut during earnings season, but they're still very good secular stories. And if interest rates stabilize or they start to fall, as we know, that actually has a positive influence on PE. So I think it is, again, I think these stocks lead into year-end, but they are highly sensitive to what rates are doing.
With rates, Michael, it's also about how they set up for corporate fundamentals. We've talked a little bit about the strength of the U.S. dollar, specifically with regard to the Japanese yen. We've seen some real weakness in certain parts of the currency market versus the U.S. dollar. Rising yields are part of that story. How exactly does that then set up big picture-wise for global economic flows? Is it a situation where the U.S. can continue to maybe help power other parts of the global economy as well? Or is it going to be a headwind for everybody that's not the U.S.?
Yeah, the currency story has been really interesting, Don. Now, we think the dollar rally is just about played out, but it's not necessarily played out against every currency. For instance, the yen is a great example. There was sort of an unusual, somewhat confusing statement out of the Bank of Japan last night. Sort of raised the cap on yields, but not exactly. The yen is weakened. Maybe the authorities intervene, maybe they don't. So I'd probably set that one aside. But if you think about other currencies against the euro, Canadian dollar, pound sterling, et cetera, the dollar's recent strength has been propelled by the U.S. economic data being comparatively better than data overseas. Not great, but better. And we think that's about played out. So probably that last push for the dollar is about done. Unless the Fed really sounds surprisingly hawkish tomorrow, I think the dollar is probably going to sort of hang in to perhaps weaken over the next month or two.